Welcome back to this month's edition of STRAT Wealth Updates. Joined here with Mike.
Hey, Neil.
Thanks for joining us. Exciting stuff to share with you today. First, we thought we'd kick it off with just a couple industry updates, items that we plan to bring more regularly to the forefront here of what's happening that can also impact your wealth. So we'll hit on a couple items there. Then we'll transition to the topic of really focusing on financing big purchases. That's been a conversation we've been having with a lot of our clients here lately, just based on the rise of interest rates, how to think about it, what questions to ask. So that's what we'll bring to the conversation here today. And then we'll wrap it up with unlocking equity within your home. This is a topic that we're having conversations more and more with clients that we wanted to have a discussion around. Reason being is interest rates have climbed, but also real estate prices have climbed. And over time, hopefully you have minimal or zero debt, into your retirement. Clients are asking, okay, how do I access this? What do I do? How can I do this in an efficient way if I need this to fund a major purchase or even my retirement itself? So let's kick it off here, Mike. If you want to jump into the overall private wealth updates.
Yeah. So first we'll talk about student loans, which we feel is timely with back to school and summer coming down to a close. So there's been a lot of news coverage around the forgiveness being struck down by the courts, but the thing that people do need to be aware of with student loans is the payments are starting back up. First payment is due in October, but interest is going to begin accruing again September 1st. So again, what that means is if you have a student loan or if you have a child or friend or family with a student loan, as we know the last few years, there's been a pause on the interest accruals and payments or sort of forbearance. That is now going to come to an end starting in September and October.
This is a major update. I mean, if you think about for people who still have student loans right now, they really haven't had to really pay those for a long time, which has also helped out with cash flow and being able to use that elsewhere. So what can people start to think about or do to prepare for this?
Yeah. Ultimately, take a look at your current budget and your discretionary spending, and starting September, October, that student loan payment should come back online in your outflows as you're looking at where your discretionary spending is going. The good news is that with the legislation, the government is offering a 12-month on-ramp. And what that on-ramp means is if you're not in a position to make that payment when it starts accruing in September and October again, you have up to 12 months to sort of get on the on-ramp and start making your payments again. And if it takes you any time in that 12 months, the government won't report your student loan as delinquent. So they're trying to give everybody a little extra runway and equal opportunity to start their payments.
Yeah, definitely something that to be aware of. I know this hasn't been on a lot of people's radar for a long time. So for folks that do have student loans, just be mindful of that and start to build that into your budget to make sure you're consistent with those payments. Also, the second one I'll hit on is just focusing on back to school, especially for adult children. This is a big topic we have with our clients who have adult children, making sure that you have a power of attorney for them. This is important, so even a higher priority having on the healthcare side, because if your child goes back to school, whether they're local or out of state, based on HIPAA rules, they are considered an adult. And if something happens to them while they're at school, you want to be able to act fast and make helpful decisions there, based on their specific health care. So this is something that you can obtain through, really any licensed attorney that we typically would recommend using someone that focuses on the estate side, but it's a pretty simple document that ultimately can save a lot of time and anxiety in those moments if something happened to your child there. But keep in mind, this is not just for students that go back to school. This is really for your children, even if they're older and not married. So if they are into their late 20s or 30s and they're not married currently, and you're looking to help them make decisions or they want you to make decisions on their behalf, go out and seek that document or give us a call if you have questions, and we can give you some references of who to reach out to. So let's jump into the first major topic here, thinking about financing major purchases. As I mentioned up front, interest rates have climbed. Activity from client standpoint continues on from whether it's purchasing a new home, a second home, a lake home, or major renovation, or even car purchases. We've been having a lot of discussions around too. So why don't you kick it off, Mike, and just talk about the framework of how we start to think about it from a client standpoint?
Yeah. Well, the first thing we like to think about is just taking a pause and realizing what the purpose for that asset purchase is. We realize buying a large ticket item is very emotional and very exciting, but to first really identify, is this for securing your family's future, improving your leisure or lifestyle, or is it an investment property? And really, what's the purpose behind that purchase? Because that's going to lead the ultimate recommendation as we get into the financing options later.
Yeah, so focusing on that purpose is we talk about that a lot through these conversations, like the why behind that drives a lot of those decisions there.
Okay. And ultimately what that purchase is going to affect too, because then based on the prioritization, you may be more or less willing to move certain things around or manage other downstream impacts based on the price of that purchase.
Okay. What else should we consider?
Really then, as we start to begin the financial conversation, we'll look at liquidity. There's all different sorts of measures and ratios that we can talk about, but ultimately, what is your current cash positioning?
Right.
As we've been talking to our clients over the last few years of what your current cash balances are those building up? What sort of interest rates are you earning on those cash balances currently?
Yep.
And ultimately, where's the most productive place to put those, right?
Yep. And then what's the final thing we take a look at?
Final thing we take a look at is really the cost of debt. And this is, I think, to try to break it down from a understandable standpoint, is the cost of your debt greater than what you're currently earning on your investments? And are you realizing positive value out of that financing for the purchase?
Right, which has been a big part of the conversation lately because we know what interest rates have been doing. Thinking about mortgages just in general, call it 18 months ago, you can get a 3% mortgage. Now you're going out and getting a, say, 6% mortgage. You look at the cost of that on, say, a $500,000 mortgage, that's a difference of $300,000 over that 30 years that you have in place. So going back to that why is a big part of that conversation, because from a financial standpoint, we help clients monetize that to understand the trade-offs between that decision based on what they're looking to purchase there. So very important, and it's significant just based on the change of interest rates and a big part of our conversations there. So let's take a look at when we start to think about how I can purchase this. Because once I define the why and look at all my options, what are my options to do that?
As we think about a waterfall approach, really option one would be, are you in a position to make the asset purchase in all cash? Do you have that cash on hand, again, in a checking or savings account or even investment account, right? You're able to just purchase it outright and avoid the cost of any financing.
Right, pay yourself, right?
As we move further down the line and we think about mortgages, again, this is going to be more common for that home purchase, but then you start to get into the cost of debt. And so if you're looking to not secure a mortgage where the home is ultimately the collateral in the loan, you're also able to take out a margin loan. What a margin loan is, if you have a large taxable investment portfolio, and this would not be a retirement account such as a 401k or IRA,
right?
So it'd be a taxable investment portfolio. You're able to take a margin loan, or might also be called a pledged asset line. And what you're able to do is borrow against the value of those investments up to a certain amount. We like to think of this more as bridge financing is another term that you'll hear,
Exactly.
where you wouldn't necessarily take out the margin loan for 30 years of fixed payments.
Right.
As again, a pro of a margin loan is there's usually less origination costs that there would be with a mortgage, but a con is that the interest rate can usually be a little bit higher than a mortgage, as well as it's adjustable, and it's also tied to the value of investments, which we know can fluctuate. So there's risk there, right, Neil?
Yeah. This is there's a lot of risk built into this, and that's where, just to reiterate, Mike said, if you're looking to do something for like 3 to 9 months or so, these are options you can look at more short term, because the other benefit here is there's really no setup cost to that. Versus like the mortgage, you want to be mindful of closing costs and title insurance costs. There's a lot that's built into that. So depending on the purpose of that, this is another option that we do look at on behalf of clients. But just to reiterate, there's risks that come along with that, which we'll discuss further. So it's all things that you want to take into consideration based on that purpose.
And if I'm interested in a margin loan, who do I go to that? Where are those usually offered?
Yeah, definitely tied to your investment account. So reach out to us. We work with our custodians to help improve the rates that are standard rates just based on the assets, the size of the loan. So those are things that we can help negotiate on your behalf based on the purpose of that loan there.
Awesome.
So these are all options if you're looking to do personal financing, right? But a lot of conversations we've had with clients too is around, how do I help my children out? I have these assets that are out there today. They're invested, they're fulfilling my retirement income needs. With the cost of real estate continuing to go up and where the borrowing costs have come into play, it's harder for younger children to make that first home purchase or save enough to ultimately get to that 20+% down payment there. So the conversation we've been having a lot with clients is around intrafamily loans. And these loans are really attractive, but it goes back to that purpose up front. Because some of the families we work with, they want their children to pay that back, which is a great way for them to build that continuous responsibility of these payments. But the benefit there is that the rates are more attractive than just standard mortgage rates. So these rates are set by the U.S. government. It's called the AFR rate, or the applicable federal rate, that ultimately resets every month. So if you're going to go down this path, you have the ability to structure a loan to potentially help fund your child's down payment for a new home or a major purchase that's intrafamily. But keep in mind that interest that is generated from that loan, you do have to report as taxable interest, so be mindful of that. Plus, if you're funding this loan, you need the cash to do that. So that kind of goes back to what we talked about before. Make sure you're analyzing the total cost, because if you're raising cash to help your children out or a loved one, make sure that you take into account any capital gains tax or whatnot that's built into there. The other benefit of this type of loan structure is that you can structure it a forgivable loan. So if you didn't want them to pay that back, or if you wanted to gift some of that payment to them each year, you can do that, as the government allows you to gift a minimum amount each year, which is the annual gifting limits that they set. Currently here in 2023, that's $17,000 per child. So if you're married, filing joint, your spouse can give $17,000. That's a total of $34,000. So continuing on the topic of major purchases or even funding my retirement, the other conversation we've had a lot with clients is how do I unlock the equity in my home? This is along the same conversation. There's a few different options though. As we take a look at that discussion, why don't you fill us in on kind of the framework we look at there?
Yeah. Well, the first obvious choice of unlocking equity in your home is trade your higher price asset for a lower price asset, or really downsizing your home.
Right.
But as we often see, Neil, depending on whether your kids are leaving the house and you want to go from 5 bedrooms back to 2, but potentially change locations or improve locations, doesn't always work to be a 2-to-1 downsize, right?
Right. And if it's the opposite, which we've seen some upsizing here recently, just based on what's happened with real estate prices, then kind of goes back to that original framework, right? What's the purpose? What's the duration? Help structure that from a financing standpoint. But this is, thinking about the opposite, right? If you have unlocked or trying to unlock some of the equity in your home, and then ultimately you do downsize, I agree. That's one of the first options. What else do we have?
So one of the next options would be, it's called a cash out refinance, or you might hear cash out refi. And what this is essentially, if you, let's say, have $1 million mortgage and you've paid up to $500,000 of principal so far, you are able to cash out your current equity or payments in the home. So you could cash out up to $500,000, the full value that you've paid into the mortgage so far, and you could refinance your home, essentially have a brand new mortgage on it.
Right.
Now, given today's interest rate environment in 2023, that may or may not make the most sense. Again, depending on your long-term goals and purpose, definitely something that you could consider as well.
Taking a look at that cash out refinance, but you're getting that lump sum, right? So you're going to be subject to all that principal and interest. So that may or may not be the best option at that point, depending on your funding needs. Right.
Yeah, to your point, if you need the full lump sum, that's likely an option. If you don't need the lump sum, another one we commonly see is you just need maybe $30,000 or $40,000 for a home improvement project. And that brings us to the second type of how to unlock the equity, and that's called a home equity line of credit, or HELOC, you might see in a newspaper article or whatnot. And that's really functions more so like a giant credit card loan.
Yes.
So up to, again, the current equity in your home, so using the same $500,000 of principal that you pay down in your home, you can borrow usually up to that limit or just a little bit less, but it's on a revolving basis, so you don't have to take the full lump sum of $500,000 of principal. You can wait a little while, you can take 10, 15, 25, whatever it is, as you need it, and repay it back. There's usually a draw period, where call it 5 to 10 years, where you're allowed to draw on that equity line of credit. and then whatever your outstanding balance is at the close of that period, you have to pay back.
Yeah, and that's, or refinance as subject to rates at that point as well. If we think more about of that structure, that can be dangerous, right? Because I mean, you have basically unlimited credit card on the equity of a lot of your equity in a home, and it definitely has to be approached with some caution. But then also those payments are going to continue to go up, so you're going to have the cash flow to make those payments as you continue to take more and more out of that house, or that's just going to compound if you're making those payments with the equity in your home, right? So that can get out of control pretty fast, and those rates have definitely skyrocketed here over the last couple of years.
So let's say if I'm a retiree, Neil, and you don't expect steady income in the future or increasing income, and really you're a retiree. Another option is the reverse mortgage. You usually have to be 62 or older to consider a reverse mortgage, so you're definitely more in that retiree time frame. Ultimately, what a reverse mortgage is you're able to receive fixed payments on a schedule that you elect on the value of your home. So you might consider a reverse mortgage more so if you don't have a lot of retirement assets, or if your taxable asset base has depleted, but you need funds to live off of, Social Security isn't going to cover that, then you can tap into the value of your home equity and start receiving really those home equity payments back to you in a certain degree as well.
Right. Yeah, typically not something we see for the clients that we work with. It is an option out there, and if that was something that you were strongly considering or wanted more information on, please reach out to us. But the other thing to keep in mind here is going back to the interest rate and the whole cost of this financing. Obviously, when you look at the conversation around downsizing and either eliminating a mortgage completely or taking a much smaller mortgage, that's going to give you probably the best outcome. All the other options, you're going to see the interest rates continue to climb, which is, again, kind of going against kind of your ability to maintain the wealth yourself, and you just end up paying the banks more money, which is that reverse compounding factor, which is going to just play against you the longer that goes.
Yep.
So, okay.
Awesome.
So if we kind of bring this to a conclusion and we think about the framework that the conversations we're having with clients, we want to make sure we're having this dialogue, because it still comes down to that framework of the purpose.
Yep.
Kind of looking at the liquidity that you have out there today, making sure that what actions you're taking to fund this is going to be cost effective. But then the last part is the debt. Like, how much is that going to cost you? And we sit down, we analyze that across the board for our clients, and really come up with our best recommendations based on the balance sheet you have, and making sure it's always in your best interest there. So that concludes the topics here today. Thank you for joining us, and certainly if you have questions, reach out to any of us on the Private Wealth team, and we look forward to seeing you next month.